Shares of L&T rise over 4% and the company is the top Nifty gainer today after reporting a strong set in the June quarter. They witnessed a 30% jump in profit while order inflow also rose 41% year-on-year.
GE Vernova T&D jumps on the back of a stellar Q1 numbers. The net profit more than doubles while margin improves by 800 basis points. The company also sees a 78% jump in exports.
Bank of India trades higher after reporting 32% growth in profit due to strong credit growth. The bank's asset quality also improves on a sequential basis. The management tells CNBC-TV18 repo rate impact has taken on 60% of the bank's book.
Allied Blenders is higher in trade after a strong showing in the June quarter. The company sees an improvement in its sales mix, while profit jumps multifold, boosted by lower finance cost.
And two new debutants on bourses today. Shares of IndiCube list at a discount to its issue price. It's lower by 12% now versus its issue price. On the other hand, a stellar debut for G&G Electronics as the shares list at an over 50% premium, holding with a gain of almost 40% from its issue price. We will have the management later on in the show. Stay tuned for that.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets, well, have moved a little bit into the red. It seems, we're into a bit of a range. The only good point today is that, in fact, we made a higher high at the start of trade. But holding on to that is a little bit sketchy. So, Mangalam, we had a relief rally. Few earnings, positive surprises, which was good as well. Let's see if we can build on to those gains.
Yeah, that's exactly, what the street is hoping for. Let's see whether the yesterday's up move that was there, whether that momentum continues or after that oversold levels and the bounce that we saw from there leads us to nothing but another consolidation. Brent crude prices, however, we'll keep an eye out on that, above $72 per barrel. A lot of stocks which are moving around. Delivery has moved to the low point of trade. Strides Pharma is at the low point as well. Post numbers yesterday did well and now selling off. In fact, a lot of these pharmaceutical stocks are lower. Loris Labs as well. After a big move in the last couple of trading sessions, both their numbers seeing some bit of profit taking. But speaking about profits and profit taking, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins us today with a stock. Jiti.
In a volatile market, we think JSW Energy could be good investment backed by strong execution, robust balance sheet and aggressive renewable expansion. The company offers good earnings visibility. In its recent move, it completed 12,500 crore takeover of O2 Power, which is having a total capacity of 4,696 megawatt of renewable platform. This deal gives JSW access to 2.3 gigawatt of projects which are expected to go live soon. For the remaining 2.4 gigawatt, it will invest close to 14,000 crore. Importantly, the company has reprioritized its capital allocation. More capex is directed towards inorganic growth, which will provide higher scale, offer better returns, and of course allow operational synergies. Now with 10,000 megawatt of operational capacity, JSW Energy, which was targeting 20 gigawatt of capacity by 2030, but at the current rate of pace, it may hit that number well before. The management estimates that a 20 gigawatt portfolio could clock close to 20,000 crore of EBITDA by FY28, which is nearly 4 times FY24 levels. The stock is currently trading at nearly 29 times its FY27 estimated earnings. Considering robust balance sheet, healthy cash flows, strong pipeline of projects and earnings growth, stock offers good margin of safety.
All right, meanwhile, keep an eye on the bottom of your screen. Orders worth nearly 1,500 crores coming in for KEC International. That stock mildly higher in trade. A lot of these companies have seen strong order inflows right from L&T to the others that we're looking at. Take a short break, come back on the other side. We do have stock-specific action on the other side. Stay with us.
Welcome back. As promised, let's focus on Arvind Limited. That one put up a steady show in the first quarter. The profits jumped up by close to 35%. The uptick in revenues was around 9%. We're now joined by Puneet Lalbhai, the Vice Chairman of Arvind, to discuss the quarter gone by and how things should shape up. Hi, Puneet. Good morning. Thanks a lot for joining in. Well, you started off the year on a decent footing, right? It's a 10% growth on the top line, but margins have improved. For the year on the whole, what kind of a revenue growth? Should we be working with mid-double-digit growth? Would that be possible? And also, if you could tell us, advanced material, that didn't grow as much as what your textile business grew. Do you see that picking up as well? Because that would be margin accretive.
So I think at the outset, let me say it's been an extremely challenging quarter because of the global trade uncertainty. And unfortunately, that uncertainty persists. So we are comparing a Q1 to last year's Q1, which was also very challenging for us. So there looks like we have, it's a decent quarter. And actually, given the circumstances, it is a decent quarter. But I expect that the first half of the year will continue to have some of this overhang of tariff uncertainty. However, the second half of the year should start looking much better. As far as AMD is concerned, we are facing a little bit of uncertainty-related holdback on orders, and we expect that to also come back on stream in the second half of the year.
So all said and done, what do you expect for this entire year? First quarter you said was challenging. You did about closer to double digits on the revenue. You said second quarter challenges continue. I suppose even if it continues this way, you could do about double digits. The second half likely to do a lot better. So like Nigel said, mid-teens revenue growth possible this year. And advanced materials, first quarter 350 crores. By when do you reach that 450, 500 crore per quarter run rate mark?
That should happen by the second quarter as far as AMD is concerned. And as far as the company as a whole, the growth should be in early double digits because we did grow quite well.
Okay.
And margin improvement scope from here? If AMD is going to bounce back, then margins could gradually move towards the double-digit mark? Or do you think it'll hover around this 9% odd?
So actually, the margin has been the bigger challenge, and the margin is likely to be the bigger challenge in the first half. So most of last year, we were in double digits. We have gone slightly lower in the first quarter, and that is related to discounts that we had to pass on due to tariffs, air freights, due to order mismatches, and demand uncertainty. So that continues till the second quarter, but third quarter onwards, that impact should be behind us.
So EBITDA margins right now closer to 9%. Do we see them go back to double digit by sometime this year?
Definitely in the second half.
Okay, definitely the second half. So far what we know is that low double-digit revenue growth for the full year, 450 to 500 crore quarterly run rate happens for the advanced textile business from the second quarter onwards itself, and margins in double digits by the second half. Let's talk a little about your textile business itself. We saw growth coming in from denims, wovens, and you are fairly confident about garments growing as well. If you could give us a sense of what proportion of your textile revenues comes in from garments, how much of it comes in from woven, and how much of it comes in from denims?
So, the way to look at our business is that historically we've been a very fabric-heavy business.
Yes.
And only recently have we been vertically integrating the business into garments. So currently garments stand at 20% of the fabric that we produce, we convert into garments ourselves. That number has to go up quite significantly. We would like it to double. And we have a very robust plan to go from about 40 million garments that we did last year to around 60 million in a year, in another couple of years. So that's the kind of investment. The focus on growth in the fashion side of the business is going to come through.
And what is the incremental delta from garments? Say you're making 100 rupees with a 20 rupee contribution coming in from garments. If that 20 goes to 40, which you want to do over the next few years, what would the incremental revenue and concomitantly EBITDA be for you?
So the way to look at it is that verticalization is a result of changing business models globally. So more than the value addition, that differs quite a bit from product category to category. However, the real reason why verticalization is important is it makes you more strategic to your customers, especially in this kind of protectionist world where there are going to be trade blocks and there's going to be mostly in-country sourcing. And of course, the opportunity to target the domestic market is much better done through full package vertical garmenting route.
Okay, all right. What about debt repayment?
So debt, we feel we are very comfortable at the level of debt we have. We are saying that we have around that 400 crore mark of long-term debt. That we don't want to go very much more than that, and we would like to sort of let working capital remain the way it is at the turns level. So the efficiency of working capital should remain.
So the net debt number that we have, Puneet, is around 1,470 crores. So it hovers around this vicinity?
Yes, it's around that 400 mark. It's around 375 or something.
All right. India, UK, they signed that FTA. And, many believe that that's a big potential for Indian producers. For you, what percentage of your revenue comes in from UK? And how big, an opportunity is for you? Where do you see that number headed?
So we are around that 10% mark at the moment, which is not insignificant, but it's also not very large. We believe that this FTA will significantly make India very attractive to the UK. It should double our garment exports at a minimum. And for us, that also represents a very large opportunity, and we're working towards that.
Are you more optimistic about the India-UK FTA, or are you more worried about the India-US trade deal? Because on a daily basis, we get some or the other comment from Donald Trump, and some days it is complimentary, some days it is not. But be that as it may, if it is between 20 to 25% tariffs, do you stand to gain or do you stand to lose?
It will all depend on how the negotiations play out and what relative tariff regime comes into play for India vis-a-vis our competitive locations. Common consensus right now is that India should be at an advantage. However, there will be short-term disruption because of tariffs moving up and down and customers trying to manage their near-term P&Ls, taking decisions to do just that. So short-term, it's going to lead to a little bit of chaos and uncertainty. But at some point, this whole thing will settle with relative tariffs of hopefully in India's favor is what everybody is feeling. But of course, we have to wait and see where everything lands.
All right, Puneet, we'll leave you with a promise to join us back as soon as there is some more clarity on the tariff-related issues, and maybe you'd be at a better position to comment on the actual impact of that in the near and the medium term on that. For now, we'll hold on to double-digit revenue growth for this year, with margins expanding in the second half of this year itself. Take a short break. On the other side, we have the management of G&G Electronics joining us after a strong D-Street debut. Stay with us. Well, one of the stellar listings of recent times, we have G&G Electronics. Shares list at a 50% premium to its issue price and now still holding on with 40% gains. There was a sharp, demand for this. The issue, a near 460 crore issue, was subscribed by almost 150 times as well, still holding with a 43% gain. The question is, where does it go from here? We have Sharad Khandelwal as well as Ajay Pancholi, who's the director, and Sharad Khandelwal obviously is the founder of the company, chairman and managing director. Congratulations, it's been a stellar listing. There was good demand, but more power gives you more responsibility, and that's what the street really wants to know right now. Ajay, your business has been growing fairly well. The two things that I want to understand from you going forward is what proportion of your revenues will come from India, how much of that will come from Middle East, at what rate are these two likely to grow going forward? And your margins, they've been between 7.5% to 9%. Where do they settle?
So first of all, thank you to the investor community at large. The resounding response and the success that we have received leads to a significant responsibility onto us, and we hope that we'll stand to the confidence that has been shown. In terms of how we see the international and domestic revenue, as you would know that the product is an international product. We have presence across India and international. And we see that the significant market, India continues to grow and so does the global markets. And we see a similar proportion to continue in terms of our overall trajectory in terms of the business growth going forward. And as regards margin, I think we have been fortunate in terms of the business that we have grown, the category that we have creation, and as this goes in the future in terms of more acceptability of the product, we see the stabilization of margins at a healthy level going forward.
And what about your mix, revenue mix?
International and India?
Yeah.
Last year it was about 75%. Last year it was 75% international and India being 25%. We don't see a significant change going forward as well. We see that the absorption on both sides and overall markets on both sides will grow and lead to a continued proportion more or less similar.
And most of your revenue comes in from sale of laptop. Will that change or that's likely to stay pat?
No, it's likely to continue in the 75 to 80% range in terms of laptops and other ICT devices.
So no big change in terms of a revenue mix. Got it. You raised this money to repay debt. So now you're debt free?
Yes, we will be.
All right. So that will be a good amount of...
debt free, and that gives us a huge opportunity.
So close to 40-45 crores of interest savings per year is what we could say. Going by that, your net debt was around 400 crores. And now you'll be debt-free. So I'm assuming you're borrowing at 10% odd. So around 40-45 crores of interest saving?
Yeah, last year we had a total interest payout of about 38 odd crores. So that will give you a sense.
All right. Sharad, what about, the pace at which you can grow from here on? The reason why I ask you is because, the industry is still largely unorganized. You expect the organized industry to grow faster. If you could give us a couple of numbers, at what pace is the organized industry growing? And at what pace have you been growing in that organized industry itself? Over the next, say, 3 to 4 years, what is that mix likely to be?
See, we have grown, thank you Mangalam, 40-45% last 2-3 years. And we are kind of doing a category creation, making industry more organized, not only in India, but across the world. Industry is largely organized, you're right, and getting more organized because there is a big value proposition. The proposition has a lot of advantages on both sides, on the vendor side as well as on the customer side. We will continue to grow at a very healthy rate as we move along because it has tremendous potential. The use case is across. On the business side, it enables e-education, e-governance, as well as for SMBs and other in all the markets that we are in. Industry is getting organized across the world from being an unorganized market, as we have seen in other items like car market, it is getting more organized and will be ahead in that. Difficult to put a number, but yes, we'll have a very, very robust growth. More responsibility now coming our way. Yeah.
Ajay, it's difficult to put the numbers here, but if we do some calculations by our own estimate, last year you did 1,400 crores of revenue. Say you add another 300 crores more this year, you're roughly likely to do anywhere between 1,700 to 1,800 crores on the top line. Your margins stay at around that 7% mark. That's about 120, 130 crores on EBITDA. And add to that, you will be saving that another, 38, 40 crores on interest expenses as well. Take the tax out, are we likely to see over 120 crores of PAT in FY26? Is that a fair estimate?
I would say you have covered it well. I would just acknowledge that we are in the right trajectory.
All right.
Okay. All right. Final question before we let you go. What about sourcing? From where do you source it individually? If you want to break it up country-wise, and anything else sourced from China?
No, we don't source anything from China. We buy from large corporates, mid-corporate leasing companies, mostly businesses, small IT asset disposition companies in India and international market. From Europe, America, India, everywhere we source from. It's a long tail of suppliers that we have.
Okay.
All right. Thank you so much, gentlemen, for joining in. The street, once again, has been celebrating this listing.
Yeah.
But then again, it is now on to you to go ahead and deliver on their expectations and promises.
And how Mr. Khandelwal said, right? With great power comes
great responsibility.
Spider-Man.
With that, we are responsible to leave you on this show of Chartbusters. And on the other side, the team of Trading Hour comes up next.